So if you've ever wanted to get started investing, but you're not sure where to start, you get overwhelmed by financial jargon and you're afraid of picking the wrong stock, this video is going to be for you. By the end of it, you're going to have a general understanding of one of the simplest and most reliable strategies for long-term investing, index investing. You may have heard of index funds before, but if you're still confused, this is going to help you finally understand how it all works. Let's take a look at what an index fund really is. Now, before we get to the strategy itself, let's understand what is the building blocks behind it. So let's start with something called a mutual fund. Simply put, a mutual fund is a basket holding many different investments. Could be stocks, could be bonds, or both. When you invest your money in the basket, you're gonna get your share of the returns or possible losses with everybody else who's invested in that same basket. Now, mutual funds are a pretty complex topic, but today we're just looking at two types. The first one is active mutual funds. Active mutual funds have managers working to pick winners and losers. They're trying to achieve a higher return for their investors. The second is passive mutual funds, which don't try to beat the market, but instead they're simply aiming to match the portion of the market that they represent. Now, you can pick a basket that represents any portion of the market that you want. It could be the S&P 500, it could be the Dow Jones, or countless others. Here's the key point here. Because the fund's job is just to match the market and not beat it, the manager doesn't need to spend millions of dollars on fancy forecasts or analysts, and they get to pass those savings on to you, the investor. This approach isn't about outsmarting Wall Street. Instead, it's about owning the entire market and letting time do the heavy lifting for you. Now, buying a basket of companies isn't just convenient for an investor, but it's actually a smart strategy. Here's why diversification matters. Picture two people walking on a tightrope. One spreads their arms out wide, and the other one keeps them narrow. Who's gonna fall first? That's diversification. It helps you spread out your risk. When you spread out your investments to hundreds of different companies across different countries, sectors, and industries, it lowers your overall volatility in your portfolio. Research shows that going from just one stock to 5 reduces the volatility of a portfolio by 50%. Having 10 or 20 different stocks in a portfolio can give you up to 90% of the maximum benefits of diversification. But here's what most people don't think about with diversification. It's not just about reducing volatility, but it can actually support long-term growth. A 20-year study by the Cambridge Associates found that a simple US stock and bond portfolio returned 7.6% per year. A more diversified portfolio with global exposure returned 8.6% per year. So you can see that it can support long-term growth. So once you've spread out your risk, the next big advantage of index investing can kick in, and that's the long-term power of compounding. Now, Einstein stated, compounding interest is the 8th wonder of the world. What is compounding? Well, let's say you invest $10,000, and after a year, it grows to $11,000. Well, that next year, the $1,000 you made in the market can earn a return of its own, and that's compounding. It's earning returns on returns. Since 1957, the S&P 500 has averaged over a 10% annualized return. Over 30 years, that's going to create a substantial opportunity for a long-term investor. Say you invested $200 every month into the market for 30 years, and you got that 10% return. You'd end up with $551,000, even though you only contributed $72,000. That means you only contributed 13% of your account balance, or in other words, 87% is attributed to the growth in the market. So the key is start as soon as possible. Compounding is going to start slow and then accelerate in an upward curve. It's going to reward people who give their money time to work. Time and compounding do the heavy lifting for you. Your job is just to stay invested. Even as your money grows though, there's one thing here that can quietly drain your returns. Let's take a look at how costs and investment fees can impact investor returns. If I set a 1% fee, that doesn't sound like much, right? Well, over decades, it can be huge. Let's go back to our example. $200 a month invested for 30 years at a 10% return. Without fees, you end up with that $551,000. Start to add fees onto it and the picture changes pretty quickly. A 0.2% fee here and your return drops to about $498,000. If you have a 1.2% fee, your ending balance is at $369,000, which means that 1% cost you, the investor, almost $130,000 over 30 years. Having lower fees is one of the reasons why index funds consistently outperform active mutual funds over the long term. According to Morningstar, the average index fund charges 0.11%, while the average active mutual fund, 0.59%. On a $100,000 investment, that's the difference of paying $590 per year versus $110 per year. That's money that could stay invested and keep compounding for you. Now, beyond the numbers, there's another reason people love index funds, and that's the simplicity and the peace of mind. Imagine you pick up your phone and there's no flashing chart, there's no breaking news alert, and there's no investing guru spamming your inbox with a hot stock tip. That is the calm rhythm of index investing. You don't have to research winners. You don't have to track quarterly reports. Instead, you set a strategy and you take a step back and let it work for you. It's perfect for somebody who wants a winning strategy from the start and then make tweaks along the way when life and goals evolve. Active traders are often reacting to every headline. They're buying high, they're selling low, they're chasing the momentum of the market. But here's the shocking part. Despite all that effort, fewer and fewer active mutual funds stay ahead of their benchmark over time. Beaver research found that by the end of 2024, in any 1 year, roughly 35% of large cap mutual funds beat their benchmark. After 5 years, that's going to drop to about 25%. After 10 years, we're down to 16%, and after 15 years, just 1 in 10 is still ahead of their benchmark. The takeaway here is that simplicity isn't laziness, it's strategy. Now, maybe you're thinking, this all sounds really great, but how do I get started? Let's talk about the accessibility of index investing. And the great news is you don't have to be rich or a seasoned investor to get started. Now, in the past, many brokerage firms would require thousands of dollars to get started, but today, many companies will let you open an account with no immediate balance. From there, you can fund your account when you're ready. Or better yet, let's set up automatic contribution. Think of those contributions as setting your investing on autopilot. With each deposit, it's going to follow the plan that you set up from the beginning. So you're not forced to rethink your strategy every time you have some money to invest. That accessibility and low entry point is a reason why index funds are becoming more and more popular. Some experts expect them to make up 70% of the assets in a mutual fund within the next decade. Now, of course, no investment is going to be without its risk, so let's quickly take a look at the risks of index investing. All this is starting to sound too good to be true, right? So where's the catch? Well, the truth is that index funds are not risk-proof and they are subject to a loss of value. If the market they track falls, they will fall too. When COVID-19 hit back in 2020, the Dow Jones dropped more than 10% on a single day. The S&P 500 and the NASDAQ dropped similarly. In 2008, the S&P 500 dropped 57% from a recent all-time high in a relatively short time period. Now, the mistake many people think about index investing is that one index fund will be enough for them. It's generally not going to be true. A healthy portfolio is going to include multiple different index funds tracking different market segments. Index funds do not erase all risk, but they do spread it out. The more diversified your mix, the better protected you are from that volatility. But still, even knowing this, many investors are going to make the biggest mistake they can, and that's trying to outsmart the market. Here's why timing the market doesn't work. Imagine you're driving. You're stuck in traffic, you're frustrated, and you can't see why the road is blocked ahead up there. So you go from your lane and you go into the next lane over. But as soon as you do that, the lane you were just in starts moving faster than the one you're in now. That's what timing the market feels like. It's frustrating and you can't see the bigger picture. A critical mistake people will make is selling all their investments and being out of the market on its best days. Long-term results are often driven by a handful of best days in the market. If you were to miss just the 10 best days over the last 30 years, your returns would be cut in half. If you missed the 30 best days over that same 30 years, your returns drop by 83%. People can get lucky once or twice, but long-term success isn't going to be driven by luck. People who try to time the market often end up behind those who just stay invested for the long term. The best investors take advantage of this by investing consistently, month after month. They ignore short-term volatility and instead they pick an approach called dollar cost averaging. This strategy is simple. Invest a fixed amount in your chosen portfolio at regular intervals, no matter what the market is doing. Some months you're going to be buying high, some months you'll be buying low. Over time it averages out and it reduces your volatility and smooths your long-term results. Here's the powerful but boring truth. Picture two investors. One spends hours a day researching for the next hot stock. The other one quietly invests in an index portfolio month after month. 10 years later, who's ahead? It's probably going to be the boring investor. Because the market isn't built on luck or trends, it's built on patience, discipline, and math. At its core, index investing is about simplicity, consistency, and time. Instead of chasing quick wins or predicting highs and lows, you're going to invest in a diversified basket that reflects the broader economy. That's going to help you lower your investment costs. It's going to minimize emotional decision making, and you get to harness the power of compounding. Now, sure, the markets are going to fall and they're going to rise in that interim period, but history shows that patience and diversification are going to win out in the long run. And in my experience, passive investing leads to a lot less stress along the way. Still, you should have a portfolio that fits your goals and your risk tolerance. If you're not sure how to build something like that, that's okay. You're not alone. A fiduciary advisor can help you examine your unique situation and build a plan that fits your lifestyle. For the average investor, that's not going to be about timing the market or spotting the next Tesla or Apple. It's going to be about staying in the game consistently. It's going to be about giving your money time to grow. So ignore the noise, keep investing regularly, and let the market's steady rhythm do the work in the background while you live your life and focus on what matters most. Thanks so much for watching. If you enjoyed this video, I do think you'll like this one here about Roth conversions, or just go ahead and subscribe to my channel if you're interested in more videos on investing or planning your future. I'm Jordan Drinkhouse, and I'll see you next time.